Hello and welcome, and thanks for logging in today for our repeat of last night's presentation. This is our first lunchtime webinar that we've done. We thought we'd just see how if people had more time in the day during this lockdown period than at night. And I have to say I've been pretty, pretty impressed with the number of people that are that have booked for this one, as well as the evening ones. So this is hi everybody, Campbell Venning here. This is our sixth webinar. It's our sixth webinar that we've done since lockdown, and it's been interesting. It's been very promising that clients have been eager to engage, and I guess it's because of the product. You know, investment property is very much here and now. The numbers are just so strong in general that it's pretty hard to stuff it up at the moment as an investor. At the same time, it's also pretty easy to do it very, very well. So today, I was about to say tonight, we're literally going to repeat last night's presentation, which is on Auckland. So for the last 2 weeks prior to today, we've been focusing on Hamilton and Christchurch, and we'll be doing a Wellington update as well. And it's been really, I guess, we just thought, look, let's engage with people and see what they see if they're interested in finding more out about these locations and our deals. It's been really, really well received, to the point that we'll probably continue to do this ongoing. So without further ado, I'm going to quickly go through an agenda. And this was yesterday, day 13, so today's day 14. I'm going to show you some weird stats on the impact of COVID-19 on New Zealand and Australia compared to the rest of the world. Nothing to do with property, it's just we've found a website which is quite fascinating, which most of you may have even seen. Then we're going to give you our perspective on the impact of COVID-19 on our property market, our industry, our business. Then we're going to get stuck into Auckland in terms of where it's at in the cycle, of what suburbs to buy and what not to buy in. Why would you buy a house versus a townhouse versus an apartment, or the other way around? Talk about cash flow and growth. And then we're going to basically go through at lower level detail 4 deals that we've got in Auckland, just to show the difference of location and type, and that not all properties created equal. So that's the agenda. I'm going to go quite quickly because I was a bit over last night, but this is my health update. So nothing to do with property, but it's just, I guess, a really real reminder that people are dying around the world. It's pretty amazing, this virus. But if I look at New Zealand and Australia, as of yesterday, we had 1,106 people affected by this virus, which is 0.0002% of our population, or 229 cases per million people. And in the last couple of days, we've actually had more recoveries than new cases, which is apparently a very good sign based on our other countries. Australia is similar. They've had nearly 6,000 cases, which is a similar percentage of the population, and similar number of cases per million people. So the reality of those numbers are that even though we're all feel like we're in jail, locked in home arrest and locked down, we have been much less affected than other countries. Not to say that it hasn't had a huge impact on our economy and our way of life, but I just think what would have happened if we hadn't been locked down 2 weeks ago. And some of the countries have accelerated the number of cases, like New York in America, is scary. So the point here is that we've had some pretty harsh rules put on us, and it's hard to cope with. You get cabin fever. But from a prudent economy, prudent health perspective, I think the government have made the right decision. So World of Meter is that website. You can watch this daily. It can be a bit depressing, but it can also be very informing in terms of, it's got some great graphs and it's got some great statistics to show you where we're at as a country. But by a lot of health measures, we have moved into a flattening curve and a dropping off of cases. And I think it's because we're an island and we're very isolated. So for the people that have never met me before, my name's Campbell Venning. I'm a property person or a property guy. I bought my first property a long time ago, back in the 90s. And since then, I've been an investor. I've been a renovator, a trader, a developer. I spent 3 years as an investment lender, and I've been in the agency world for 7 years now. So property for me is my way of life. It's been very good to me and my family. It's given me some amazing experiences and introduced me to some amazing people. And I guess now I'm turning into one of those old farts in the industry who has been around the traps, and I've seen a lot. I've seen 4 cycles, and we're going to talk about cycles and property clocks later. But yeah, I guess I just think I'm a North Canterbury born and bred guy that's spent a bit of time around the country and the world. But the reality is I've been involved in property on a number of levels, from finance to coalface to sales to renovating to trading, that I guess you learn a lot. I call myself a bush lawyer. I've seen the good and the bad side of property when it goes wrong. So yeah, I always threaten to my ex-judge father that I get my LLB. I'm not sure if I want to follow through with that anymore. I can't see myself practicing as a lawyer, but I know a lot about property law because I've been involved in it for so long. So the Property Factory is a business that I started up. I actually wrote the business plan for it quite a few years ago, but I only really turned it on last year. And basically, I was trying to solve a problem that didn't make sense to me. And at the time, we had I think 15,000 real estate agents in the country, and we had this 50,000 household shortage. And we had builders that were not selling properties and developers that were not selling properties. And I thought, this is crazy. Why? We've got demand, we've got supply, marry the two together. So for me, it was a solution for developers and builders who needed volume property sales, and for customers that needed to buy investment property to live off in retirement. It was a portal or a method of getting to those deals. And our goal is to provide opportunities that are better than anything else in the market for our customers. And we do that through bulk sourcing. You know, if I'm going to a developer and say, right, I can move 20 or 30 or 40 of your properties, they're going to give me a far better deal than if I say to the developer, hey, I've got one buyer for you. And that's our model. We look in bulk. That's why we call it the factory. We look in volume. And we've got a very experienced team. And I guess we're doing something right because we've moved over 2,000 properties over different businesses over the years. And the Property Factory is a very digital version of those businesses that I've been involved in as time's ticked on. We are in a technical environment or technology-focused environment, and it's actually amazing how much due diligence and how much of a property transaction you can do online, to the point that we've just launched digital signing for sale and purchase agreements. The other thing that I'm passionate about, I did 10 years of renovating, renovating old houses, worst house, best street. And I did it off the back of the 1987 stock market crash. And it was in the 90s. We were still in a recessionary environment. Interest rates were 12%. And I was buying beautiful houses in great locations that were just needing big renovations. Whereas now, Property Factory, we only deal with brand new. And we've done that because investors in New Zealand that are buying secondhand properties now are completely underestimating the cost of renovating and the cost of keeping those properties current, because New Zealand's housing stock in general is very old. We're going through a very real shift between old to new, in that some suburbs it's cheaper to buy a new house than an old house, which does not make economical sense. It does not make financial sense, and the only sense it makes emotional. And if you're buying an investment property, there should not be an ounce of emotion in it. So 21st century investing is actually about getting your mindset around smaller houses, smaller land sizes, and the fact that the world is moving to those types of accommodation. And tenants in their droves are moving out of old crappy rentals across the country into new where they can. So if you're an old school landlord that was holding on to your cash flow positive properties in South Auckland that you paid, I don't know, 180, 250 grand, and they're now worth 700 or 800 grand, our advice is to sell them and replace them with 3 brand new ones or 2 brand new ones. Because if you look at return on capital, it's a short discussion, because the rent on a $700,000 or $800,000 property is probably not that much more than the rent on properties that we're selling for $300,000, $400,000. So that's our other mandate, is that we made a very sensible commercial decision that we would only promote property that is, something's happened to my camera. We would only promote property that was new. So, hang on, I don't know what's happened here. Stand by, team. Not sure. Can somebody just send me a message? Can you guys see me or not? Or have I lost camera? There's a Q&A box and there's a chat box. Can someone just tell me if they can still see me? Oh, you can. Cool. Thank you. I think what's happened is my good colleague's logged in, and I just need to change his name. But anyway, David's here now, so I won't change his name. And you guys can still see me. I just can't. My camera's just gone off, but it's obviously still working. So basically, in the world of property, we have got a environment where it just doesn't make sense to buy secondhand when you can buy new for less, 10-year warranties, double glazing, healthy homes, blah, blah, blah. And if you don't believe us, the Reserve Bank or the government have, using the Reserve Bank, have imposed to make it harder to buy secondhand than new, because they've mandated the banks that they'll only lend 70% on secondhand versus 80% on new. So from that point of view, it's you've also got a government that wants you to buy new property, whether that's your home or your rental. So that's our business in a quick nutshell. So let's have a look at let's jump into the economic review of New Zealand from a how is real estate affected by this lockdown? So we're only 13, this is day 14. Yesterday was day 13, but we've had massive changes. This is a huge event, and they're calling it the largest global crisis since the last war, the World War II. New Zealand, we've had airlines go from $6 billion worth of revenue to $500 million worth of revenue. That's 8% of that's a 92% revenue drop. People have been made redundant. But so there's no question that there's some industries and businesses in New Zealand that will change forever, some that will stop and won't start up again. But this isn't a typical recession, and in our space in property, we've got historically low interest rates and they're still dropping. I just fixed 3 loans in the last 2 days that were floating at 5%, and I just forgot about them. And I wrote to the BNZ and I said, what's the current rate that you can do for these? And we just fixed them at 3.05% for 18 months because we think they're going to go lower. So in the world of property, that's almost a 50% pay rise on my biggest cost, being debt. So these historically low interest rates allow you to buy brand new property that's cash flow positive in great locations, and I'll talk more about that later. So this virus hasn't changed that. If anything, it's actually pushed rates down. So, and with rates going down, we see more people come into real estate. So we're actually expecting an uptake. Secondly, housing shortage. This is real. It was real before the virus and it's real still. And everybody I've spoken to in the last 2 weeks who are in our industry, whether it's property managers or mortgage brokers or competitors or customers, and builders, developers, if construction slows down, the demand is only going to carry on, and we've already got a shortage. So it could actually, housing shortage could get worse. Now, the big one that we don't know about is unemployment levels. I have read 6% through to 30% unemployment in New Zealand, depending how long this thing goes on. Now, if I listen to the health experts and the economist experts who really know what they're talking about, most of them don't think it's anywhere near 30%. If we had 30% unemployment in New Zealand, we would be into deep recession. So there's a lot of variations on how this will look, and none of us really know. Speculation is probably dangerous, but it's a big question mark in terms of how we're going to look at the end of this. But halfway through the mandatory lockdown that the government has said that's going to be 1 month, 24 weeks, we're actually looking like they made a really, really, really good decision. So let's see how that pans out for the next 2 weeks. And as long as you don't get cabin fever and bounce off your walls, we'll talk about the other things the government done. They've put surpluses in place with their large surpluses. They've been able to put subsidies, tax relief, tax deferral, mortgage deferral. They've done all this in 2 weeks. I've never seen this government act so quickly, including earthquakes and terrorist attacks. The speed at which this government has operated in this environment could probably get them re-elected on its own. And there's certain things they can't control. Share market, there's some shares that have just tanked. But again, most shares are funded via cash. So the people that don't have to live off those dividends, or the people that don't have to, who aren't in and out of the market, they can sit on those shares and wait for them to rebound, because they will come back up. And most shareholders in the stock market are cash funded versus debt funded. And the ones that do get out, we're expecting to see them, again, more pressure into real estate. So that doesn't, in my world, impact too much. But, job losses are real. And in the meantime, a lot of those people are getting paid through these government subsidies. Employers are reducing hours. They're encouraging flexible work and business efficiency to allow to hold people in jobs. So I don't know many in our space who have in fact, I don't know anyone that's laid anyone off yet in the real estate industry or the construction industry or the finance industry or the property management industry. I don't know anyone. We're all holding on to our teams, and we do believe that this thing's going to pass. Or that we are not going to be as affected. I think how we live will change forever. I think we'll all be thinking very long and hard before we go to Italy. And ironically, my wife and eldest daughter were supposed to be there right now. They'd been planning a trip to Italy for a year. And they were devastated. But I was pretty happy they weren't there when the thick of the virus hit Italy, because it's been one of the worst affected countries. So let's just reflect on crises and leading into property. The best way to look at how the country is going to perform or be impacted is to look at other major crises. And I mentioned the first one, and we'll talk about cycles later, but I've been through 4 property cycles, and the first cycle was the 1987 stock market crash. Now, I was a teenager when that happened, but I bought my first property off the back of it. And I was also given a front row seat in the impact it had on New Zealanders, and that my father was paying 60% tax at the highest threshold. Interest rates on our home was 20%. And he had a very successful growing business in Christchurch and North Canterbury as a lawyer. And he packed us all up and moved us to Hong Kong, where tax was not 60, I think New Zealand was 64% or 63% at the time, at the highest tax rate. Interest rates were 20%. And Hong Kong tax was 17%. And he became a judge. And for the next 15 years, he lived in Hong Kong. So I got a real international view on life as a teenager, being moved to Hong Kong. And when I moved back to Christchurch to finish my schooling, I ended up getting into property off the back of that, because it was the property investors and first home buyers are often the first market to move a recessionary market out of recession. And I was a first home buyer in those days, and that gave me a lot of insight. But at the time, the country was in deep recession for a number of years. My first home was in the mid-90s, but it was off the back of that. So the next big crisis, which I saw front and centre as a property developer, was in 2008 with the global financial crisis. And this was very different to what's going on now. Like the stock market crash, the country was overvalued, interest rates were high, farm subsidies were removed, and the farmers had to provide for themselves, and they were a topped up industry at the time. And then we had the 2008 crisis. There was no money around. Banks were going broke. Interest rates were high. The dollar was overinflated. The banks had overgeared consumers on housing and on consumer debt. So none of those things, from 87 to 2008, none of those things are the same. So let's look at New Zealand today with this coronavirus, COVID-19, and the immediate impact on it. Well, the first thing is it's physical. It's people. We're isolating in bubbles, and we've got to stay in our zones and keep away from people and spray and wipe and wear gloves. It's surreal. There's movies that predicted this thing would happen at some stage, but to actually see it happening it's a bit of a culture shock. And it's not only that, it's happening so fast, and that's the reality of technology. And companies, governments, countries, they've responded immediately. So if we then look at New Zealand's economy, amongst that response, we're actually in good shape. And even though the country's banks were in very good shape in 2008 when the global financial crisis was in the thick of it, the banks were in good shape internationally compared internationally, but we still had overgearing, we still had overlending, we still had negative equity, but we managed to ride through it. But we were one of the front industries. We were effectively tourism today in 2008. Whereas real estate, when you look at the basic drivers of it, we're not at the front of the queue here in terms of immediate impact. We're probably at the back of the queue. So from our point of view, it's terrifying and sad to hear all these people losing jobs in the travel industry. And there is one part of our industry that's affected that I'll talk about in a second. But our economy is in such good shape that most economists that I've read, most people I've spoke to, think we'll bounce back pretty quickly. Now, the biggest impact in our space is no questionably the Airbnb or short-term or nightly market, which I've been in 15 plus years. And I've been recommending all of our customers in the short-term market, and there's not that many because it's not one of our core products, but I've just been in it personally for a long time, convert everything to long-term furnished or short or long-term unfurnished. The premium returns that we've been getting for a number of years are going to go back to normal. And whilst we expect New Zealanders will spend more time in New Zealand versus internationally, that's going to take a while. So if you're sitting there with a short-term rental in Queenstown, my advice is to convert it to long-term unfurnished or long-term furnished if you can. Because there's so many of those properties hitting the market right now, and there are so many of them that are empty because of the drop in tourism. You're going to see Queenstown like the 90s. It's a different place right now, and that's sad. I used to own, we had a quasi home there for a while. We've had rentals there for a long time. And in terms of the impact on those properties, our family properties down there, we're running around like headless chickens to get income coming from them. But we knew and totally expected that, Queenstown would change at some point in the future, but we never knew how or why. So Queenstown hasn't had a global financial crisis. Queenstown's had a nuclear bomb go off in it. It's such a deep and dramatic impact. And my gut feeling is that the only thing that will save Queenstown is construction and local tourism, because the people that are out of jobs there are mainly in the tourism industry. But there's been a huge impact of building down there because of demand's exceeded supply. So New Zealand is visiting that location, and builders carrying on building houses and selling to owner occupiers will save it. But the unknown quantum is how many of those jobs are related to tourism versus other industries. And look, we won't know that for weeks and months to come. But if you listen to the mayor down in Queenstown, it's a bit doom and gloom at the moment. So we've had an impact in real estate in that location, but you're talking 20-odd thousand people versus Auckland at 1.6 million. So I don't see that having a national impact. Property managers, they're already working it. So let's jump to other parts of our industry. So Airbnb is probably not the market you want to get into this week or this month or even the rest of this year. And if you're in it, think about looking for long-term tenants, whether it's in Queenstown, Auckland, Wellington, or Christchurch. Big cities, they'll rebound quick with corporate market and local tourists. So again, I probably wouldn't jump to do those in places like Wellington where there's such a shortage of accommodation. But for safe investing, long-term, low-risk investing, long-term unfurnished rentals are the backbone of New Zealand's property market. So let's look at the other industries. Property management, they've been working very, very hard behind the scenes to get smart, as we have. Banks, they still want to lend money. We just did I interviewed 2 of our brokers, and we're going to put those up on our website soon. The banks are still lending. What they're saying to brokers is, hey, we've been hit with mortgage relief, business loans, employee loans, or personal loans. Can you just accept a bit more of a delay in getting to your investment loans? So investment lending's not as important as supporting business or more people that can't make their mortgage payments. I completely get that and respect that. But they still will be lending money to investors and first home buyers. They've had a huge, huge relief from the government with $30 billion worth of monetary easing and supply of funds into the market. So people are still going to buy and sell houses. People are still going to buy and sell investment property, and they will adapt social distancing rules. Construction, can't see that coming to its knees. They will adapt in similar ways that they did to health and safety changes that came in place a number of years back. So I don't see anybody in our whole industry, apart from short-term, the owners of short-term property, I don't see anybody having major shutdowns like airlines or tourism operators in Central Otago. I don't see massive changes at all. And I think what's happening already is we're getting this new norm. We're used to crossing the road when you see people walking towards you. We're used to not touching things in our face. We're used to getting on in a more isolated environment. That's tough, but it doesn't, and if anything, it's encouraging me to get back into face-to-face commerce. And this is great because we're talking to customers online, but I'm missing my staff, I'm missing my customers, I'm missing hanging out with my friends. It's motivating to do the right thing by the country's recommendations so we can get back to normal life. So normal life, if you're not aware, is actually starting up already. There's some fabulous images online the other day of Air New Zealand's planes being converted to blooming export transport on seats. It was some great photos. Check it out. Because 30% of our New Zealand-made goods has gone to China, and they're the first country to recover, and they're back ordering again. So if you look at our exporters, they're running amok, and the primary goods that we create are in demand in the Northern Hemisphere. We've just got to get them there safely, and there's smart people that are making that happen. Community spirit. I have, I saw this during the 2011 earthquakes in terms of people mucking in and helping their neighbours and helping their friends and family. You can't do that in this crisis, but people are talking. People are on the phones. They're putting notes in people's letterboxes of, can we go to the supermarket on your behalf, for the elderly. We're showing character at the community level that I think is wonderful, with the teddy bears and notes on windows. The New Zealand character is strong, and even internationally we're being given a clear bill of health as a country that's leading the way in dealing with this crisis. And I think that'll help us get out of it on the other side. So let's go back to real estate. We've still got so this virus it's only 2 weeks old in terms of lockdown, but we've still got an undersupplied housing market. Will it slow for 4, 6, 8 weeks, 4, 6, 8 months? We don't know. But I believe that demand is so strong that people will want to get back to business in real estate as quickly as possible. And that's homeowners and investors. I think business will adapt to working more remotely. Even us, we've discussed, well, how often do we need to go and see clients face to face? We've got a great relationship with our customers. We talk to them. We do calls like this. We can do one-on-one calls with them. So the demand for housing, assuming that stays the same, we might travel less until it's totally safe to, but do more of these events because we know the housing demand's there. Plus, we've also got a government which, whether you vote National Labour or somebody in between, they've been smart around this crisis and unbelievably quick. I've never seen governments react. If you look at the American government versus the New Zealand government, Jacinda and her friends get a big tick for acting fast. I mean, Trump mucked around and he's got serious problems on his hands in terms of their hospitals are going to become overrun if they're not already in some locations like New York. We've paid out $6.6 billion as a country as in worker subsidies, and they're expecting it to go to $10 billion. It's 2 weeks later. We've had 1 million people who have already been paid out. So employers are holding on to their staff through these subsidies, and that's going to have a huge impact on the economy than if they hadn't done that. People would have been in the welfare queues far more than they have been because these subsidies have kept people, enabling them to pay the grocery bill. Okay, so that's the economic update on 30 minutes in. I'm a little bit behind. Any questions on any of that? Because I guess we are in the market, and I think David is answering them as they go. So yeah, I think he is. I think somebody's answering the questions from one of our team. So I'll answer a few as we go. But from no, he is not there doing it. So I'll wait till the end actually. No, Leston's put one in there quick. How will world economic downturn impact new builds? For example, costs due to price and availability of materials. Good question. So, I haven't thought about this one. How will world economic downturn impact new builds? For example, costs due to price and availability of materials. Gut feeling, things should get cheaper. We've had, when demand exceeds supply, prices go up, economic theory. So if China starts producing materials that we use in building, and we've got an ability to get it, I would have expected that in the short term prices will be lower because they're like, we've got to get production going. And as one of the first countries to come out of this, I would expect materials would be cheaper. People have had a knock to their economical balance sheet, so they'll probably take less to do a job if they've had a slowdown and they're earning less now. So I'd expect in the short term things could go down, but law of supply and demand, once we go back to normal, we'll go back to normal prices. So my gut feeling is short term could drop, medium term will go back to normal. But the one thing that is real is people want to transact, including New Zealand. And we're relatively self-sustainable, but in the construction sector, yes, we do import a lot of raw materials. We even import workers. But I don't see those changes doing a lot over because it's such a short. It's not a 5-year recession. At the moment, it's 14 days. So, but good question. And Brian's answering my questions. There you go, Brian. Thanks, mate. One of our wonderful team in Wellington. So I'm going to carry on. And in the meantime, I'll let Brian answer the questions as they come in, but I'll have a look at them at the end. So that's our sort of view of what the New Zealand, and this isn't just Campbell's view or Campbell and his team's view. I've spoken to our mortgage brokers. I've spoken to our property managers. I've spoken to a lot of our builder developers because that's part of the business I look after. And no one's saying, oh, we're stuffed, we're out of it. They're all saying, this is an inconvenience, but it's a very sensible inconvenience, but we expect business to go back to normal pretty soon. That's the message I'm getting. That was before all these subsidies and all of these supportive measures have been put in place. And it was also before the curve or the flattening of the virus curve has started to happen, where now we feel like we've turned a corner. But the next 2 weeks will show a lot more, but it looks like we have acted quickly enough that this thing hasn't blown out of control. So back into the property world. Sorry, I've got to get my mouse back to click the next page. All right, so park the virus for a second. Let's have some more positive talk about the country and where we're at. So the world of investment property is not rocket science. And one of the biggest problems people make is when they start getting emotional about it, or they start bringing their emotive drivers to making business decisions. First of all, property investing is a business. It's not your home. I live in a 1920s villa, and our business does not sell secondhand property. I swore to my wife when we moved back to Christchurch that we would not buy an old house. We looked at 40 houses, made offers on 4, and bought an old house, and we love it. I'm 51 years old, and I've been renovating old houses for about a third of my career. And this one, someone else spent $1 million renovating it, and we just love the character. But would I buy this as a rental property? No way. Would I buy, if I was retiring, would I buy an old house? No way. I'd buy a brand new one off one of my good vendors or developers. But it's parking investment property from your home, different things. And we've got some clients that don't even own a home, and they own 3 or 4 rentals, and they rent. So investing is a business. And the simple formula, Property 101, is if you buy 5 houses, and it doesn't have to be 5, it could be 4 or 6 or 7, it depends on your circumstances. But if you buy on average 5 houses over 10 years, you hold them for 2 cycles, which is typically 10 to 15 years, and you put all of the cash flow coming off those properties onto debt repayment, and you hold on to those properties, you, by historical measures, should be able to live off rent in retirement. It's not rocket science. Property 101. It's easier than a trading business. It's even easier than your job. Math of $20,000 a year in rent, $15,000 a year in costs. The surplus cash pays off the debt. All of a sudden, you've built wealth. That's how simple it is. And it's amazing how people, they don't understand it because they've never been taught it. But a lot of the people that get into it without any good training or any good teaching or any good advice or guidance get emotional, and they get in and they get out because they have a bad experience. Now, this is where Property 202 comes in. Property 202 is the core strategy, which is in 100 books and is, again, not rocket science. First of all, some properties are cash flow properties. Some properties are capital growth properties. And what does that mean? Okay, so your $2 million property in Auckland is a capital growth property, but your $500,000 property in Auckland is a cash flow property. And I'm going to show you some of these later. In Christchurch, your brand new $350,000 one-bedroom townhouse is a cash flow property. However, your $1.2 million 3-bedroom, 3-bathroom property in the green frame is a capital growth property. And the difference is rent less costs equals positive or negative cash flow. And the mistake that people make is that they buy their properties around the wrong timetable. So let's just look at this from a banking point of view, because most customers that are buying property are funding it through bank debt. So timing is key on what you buy and when you buy it. And so just work with me on this. So banks look at 3 things: character, income, and equity. Okay? And they won't give you strategy around property. They'll just say yes or no to the loan. Now, if you build a property portfolio properly, self-funding it becomes the norm. And you can fund it from cash flow and future growth. So the goal is not to fund it from your income. So if you buy 5 properties, like we said on Property 101, and you buy cash flow positive properties first, over the coming years, not 10 years, over the coming years, you'll have a self-funding property portfolio. And that doesn't make sense to a lot of people because it seems too easy, but it is real. So because in the bank's world, if you go and buy capital growth properties before cash flow properties, you will eventually run out of what's called borrowing power or income available for debt servicing, and that's a term the banks use. Whereas if you buy boring, long-term, low-risk, cash flow positive properties first, when you go to the bank to buy the property in Queenstown or Remuera or Newmarket or Central Wellington, you have surplus cash flow from those cash flow properties that will give you the funding to buy a capital growth property. And the mistake people make is when they get it around the wrong way. So timing is key here, that you buy your cash flow properties before you buy your capital growth properties. Property 202. And right now, we are only promoting properties in the main cities because we can buy brand new cash flow positive properties in Auckland and Hamilton and Christchurch and now in Wellington. We just launched a Wellington deal. They've been hard to find in Wellington because that market's been so strong. The demand has exceeded supply, and that it's been near impossible to find cash flow positive properties in the new product space unless you go to locations that we believe you don't need to. So, this isn't witchcraft. You can buy a property today for $350,000. The costs will be $15,000 and the rent will be $20,000, and there'll be $5,000 in pre-tax positive cash flow. And let's put that in the context of this virus. If you had just lost your job and you had 5 of these properties, that's $25,000 per annum, right? Per annum that you would have had net coming in after your properties were self-funding. And that's on old interest rates, and interest rates keep dropping. So 100% financing into this business pays money from day one. So it's a cash flow positive business if you do it properly. And I guess when you're first new to it, or if you're a first home buyer or a first home investor, that might sound too good to be true, but it is real. And when you talk to the different experts that we recommend you go and see, they'll reinforce that to you. So let's get to property 303. Property 303 is basically when it is getting a little bit more complicated. You're blending market timing with property cycle and location. So I'll try and explain this one a bit faster than I did last night, because it took a wee while. I spent a bit too long on this last night. But first of all, property cyclical. Every 7 to 10 years, we go through a new cycle. And then it's very location driven. And New Zealand is very straightforward to predict because things typically happen in Auckland first and then move south. The exception to that rule is things like the Christchurch earthquake, and when I show you some graphs soon, you'll get that understanding. But if we work on the basis that property is cyclical and we have these little mini booms and flat periods and sometimes drops in the market, on average, New Zealand property moves at about 7% per annum over the long term. So 7% has sort of been that golden number that people have used as they should be getting 7% because that's the national average. So if we work on the basis that it's cyclical and that it does go up on average every year, and adopt a long-term approach to it, okay, that's the other thing. It's not get rich quick overnight. Property is about the long term, not the short term. And the risk that people take is that they expect returns too quickly. So then let's apply what's called the property clock on top of this. So if property is cyclical, our way of reading where a market's at is to apply what we call the property clock to it. Property clock is, where is a market at right now? So where's Auckland on the property clock? Is it at 6 o'clock, or is it 10 o'clock, 11 o'clock, 2 o'clock? My picture on Auckland as a location, it's between 10 and 11 o'clock because it's flattening, okay? And it's flattening because of infill housing and greenfield subdivisions. So that's not your Remueras, that's not your Herne Bays, that's not your $2-3 million properties. That's your infill housing, smaller houses, smaller land size, and that's effectively solved the Auckland housing crisis, and it's also flattened the price levels in Auckland across the board. Because if you paid $3.7 million for a property in Herne Bay last month, I don't see that doubling anytime soon. I don't see it going backwards, but I don't see it doubling. Whereas if you've bought a property in West Auckland that for $450,000 a one bedroom, or $500,000 or $600,000 for a two bedroom, I do see that doubling over the coming years because it's so far behind the median for the location. It's a new product. So I see that at 6 o'clock. So in one market, you can have suburbs and products that are different stages of the property clock. Christchurch, we've been at 6 o'clock for a long time. We've just started to move. But second-hand housing, as far as I'm concerned in Christchurch, that's at 12 o'clock. Whereas new housing, brand new townhouses, apartments, I see that at 6, 7 o'clock. And we've got a long, long, long way to go in terms of that growth cycle. So every location is different, and it depends on the product that you're talking about. Infill housing in Wellington is probably at 7 o'clock, whereas nice apartments in the CBD, they're probably at 11, maybe 10 at best, 11 o'clock maybe, because they're getting to a point now that it's getting unaffordable for even those high-income workers in Wellington to afford apartments that they may have paid $1 million 5 years ago that are now $2 million. So it's a hot market in Wellington at the moment, but I see it leveling off over the coming years because affordability is starting to kick in. So when you match Property 101, 202 and 303 together, there's a bit going on. It takes a while for people to get their heads around it. So one of our business goals has been to help explain it and articulate it to customers through our reports, through our due diligence, through our deals. So when we present our deals, we always apply the property clock to it. We look at the history for the location. We do a forecast for the location. So you want to buy at 6 and sell at 12 or reinvest at 12, but it's not always possible. But what we can do is arm you with the tools so that you're a better reader and a better judge, you make better judgment calls on the market. And that's one of the other things our business does, is it will give you our opinion on it as well. So that's Property 101, 202 and 303. And these are concepts which I'm hoping make sense. So now we're going to jump to Auckland, because for the last 3 weeks we've been focusing on Christchurch and Hamilton. We've got Wellington to come. So today is all about Auckland. And pretend that you employ all those different ways of buying property that we've just covered. And now let's zoom in on Auckland. So first of all, let's have a look at a judgmental map of Auckland. So out west, we've got one of my favourite TV shows, the Outrageous Fortune, with Cheryl West and co. Down south, we've got extra police resources to keep the south in check. Up north, we've got all the weed growers, cargo ships, tourist ships coming in and not being allowed to berth up in the Gulf. So Auckland is a very spread out location, and this is a bit of a tongue-in-cheek view of it. You've got CBD, double grammar zone. I'm gonna bring it now back into the real property world. We look at Auckland as 4 cities within one location. And with my tongue in cheek, those different locations are somewhat real in a humour sense, but from a economical sense, as a city, you've got regional locations which have actually performed almost identical over the last 20 years. So what that does, it makes an extremely predictable location. And if you look at this red circle that we've drawn, that is the 15-kilometre radius from the CBD. Now, internationally, property starts in a location, being the centre of a city, and moves out. And those different other regions from Franklin to Papakura, Manukau, Waitakere, Rodney, and North Shore, all those other districts have actually performed very equally across the board. And if you look at the average house price in each location, give or take the different areas, the closer into the CBD, the more expensive, and the further out, with the exception of the North Shore, because that's lifestyle as well as, it is further out, but you've got beautiful beaches that drive that, and you've got a great motorway that can get you in and out quicker than some of the southern suburbs. So, but still, Papakura at 692, Manukau at 850, that's not that much different to the North Shore at $1 million. So if you look at Auckland as a whole, it's performed extremely consistently over a long period of time. And I guess that is good because it enables us to predict how it's going to perform over the future. So if you look at that over the 20-year average, it's almost like you've got these 10 worms or 7 worms that just follow each other. And Auckland City sets the pace. North Shore's not far behind it. Then you've got Rodney District. Every regional location or authority in Auckland pretty much falls along the same scene. Then we put Auckland as a city against the rest of the country. So it's the economical powerhouse. Half of our country almost lives in Auckland, and it sets the tone. And what happens in Auckland typically then flows south. So the green line represents Wellington, and it's had steep increases over the last 4 years that I explained before, to the point that I think housing is going to start levelling off there soon. Hamilton, in my opinion, still got a long way to go with its median price is only just over 600,000. But that low line, the blue line, in my opinion, is ludicrously low. Christchurch is disproportionately too cheap, in my opinion. It's going to be impacted by by tourism, there's no question. But if you look at the base economy of Christchurch outside of tourism, it's pretty strong. And we've got a construction sector that's been rebuilding the city. We've got people moving here for lifestyle because it's so cheap. So I see the economics of Christchurch being very non-affected by this virus, because yes, international tourism will slow here, but that's only one of the drivers of the Christchurch economy. And as a place to live, I can see, it's already happening. People are moving here because the cost of living in Christchurch is so much cheaper than Hamilton, Wellington or Auckland. And it's job driven, and I see more and more jobs all the time coming out in Christchurch in different sectors. The same way that happened in Wellington when we first moved there in the 90s, when it was literally a head office for corporates and a government city. It was literally Canberra, whereas Wellington now, film, tourism, education, technology, it's got so many industries supporting it that it's a very safe city from an economy point of view, and I see Christchurch following in Wellington's footsteps. So let's break Auckland now down into the areas that we're predicting as hotspots in terms of locations that are on the fringe of that 15K radius, or that are just within that 15K radius. Now, if we look at Te Atatū Peninsula, if we look at Henderson, if we look at Sunnyvale, if we look at Te Atatū South, if we look at Birkenhead, Kelston, Glen Eden, these are the suburbs that we've identified as hotspots in Auckland for two products, infill housing and greenfield subdivision. And what that means in English is a developer has found 3 crappy old houses that are not meeting current New Zealand building standards. They've bowled them and they've created 10, 12, 14, 20 townhouses. And that's the market which you want to be in Auckland, not the $3 million house in Herne Bay, not the $1.5 million apartment in the CBD, because they won't be cash flow positive. And if you're a first or even second or third time investor, you don't want to be buying $1 million plus apartments anytime soon. So we focus on the product that makes sense from a yield point of view, where it's had moderate growth in the suburb, and then we're going to expect accelerated growth with this new product being infill housing and greenfield subdivisions. So that's where we're focusing in Auckland. So just a quick wrap up of the numbers there. There's currently just under 1.7 million people living there, and expected that to grow by another 700,000 over the next 30 years, the government forecasts. And that means more dwellings, more jobs, another 300,000 houses, 263,000 jobs. And the city centre will always be the focus. It will always be the core for tourism, education, cultural, civic activities. And it's becoming a much more residential centre. I remember in the global financial crisis, there were 12,000 CBD residents in Auckland. And at the time, there were 12,000 properties on the market in central Auckland as well. It was crazy. It was like, this doesn't make sense. And it was because most of those habitants or those people living in those properties were rentals, and they were debt funded, and a lot of those people just had to put their properties on the market because banks wanted their money back. Now, Auckland CBD has a huge number of long-term residents, debt-free residents. You've got apartments at the bottom end through to the $2-3 million end. So Auckland CBD it's not Hong Kong yet, it's not Auckland yet, Sydney yet, but it's definitely moving into a highly desirable place for residents as well as all of those other drivers. But it's not the only place, and if you look at it from a cash flow point of view, it's very hard to buy brand new property in central Auckland that's cash flow positive, which is why we're now looking at places all around the areas from north, west, east and south, Albany, Westgate, Manukau. They will develop as major centres, because if we round up Auckland to being 2 million people in the coming years, that's 4 cities at 500,000 each. And that's why we look at Auckland as it's kind of 4 cities in one. It's such a big spread out place. And if you look at the major change that I believe saved Auckland as a city that was so clogged up, and it still is at this point. However, it's changing. It's changing its whole demographic from an infrastructure point of view, in that you've got these regions where the government and the councils have identified where high density, medium density housing is going to go. And Hobsonville Point's a very good example of that. Manukau, out west, we've seen other big tracts of land that have been identified suitable for high density and medium density. So the red marks on this graph show, this map show the areas that have been identified under the Auckland Unitary Plan for high to medium to low density. And this is where developers have been buying up land and making smaller land sizes, smaller houses that actually hit the investor sweet spot perfectly. So let's now break it down further into where that's come from and how that's impacting Auckland. So this is why, I guess for us, it's the economical driver that dictates where people should buy investment property. So in North Shore, Birkenhead and Beach Haven, as well as North Shore, further North Shore, Silverdale, Millwater and Ariwa, out west, Waterview, Te Atatu South, Te Atatu Peninsula, Kelston and Hobsonville, we're seeing huge amounts of infill housing going in there. And these are the locations which we will be sourcing and packaging and promoting as the suburbs to buy investment property in that makes sense economically now and also for the long term. Cash flow now, capital growth for the long term. Now, 6 years ago, we wouldn't have had these products didn't exist. We were able to get cash flow positive property in the CBD, but that's near impossible now with the cost of construction, the cost of the meter rates that Auckland apartments are selling for. Unless it's a purpose-built investment complex, which we haven't seen any for a long time, it's very hard to make the numbers work in the apartment space. I expect we will start seeing it, but we haven't for a while. So let's look at that that's infill housing and new subdivisions. Subdivisions are more medium to high density, but the properties that are going into those subdivisions are almost high density, but more medium density. So that's how infill housing and new subdivisions overlay into existing locations where you're seeing all of this construction going on in Auckland. And if you're an Auckland resident, you'll know what I'm talking about. It's subdivision after subdivision, house after house. And a lot of those are being rented. A lot of those are first-time buyers, or a lot of those are people that just can't afford the $1 million house in Auckland, and they're buying $500,000, $600,000 and $700,000 housing. So then let's look at product. I've been talking about apartments and houses and townhouses. So the best way for me to describe product in this space is to put it on a risk and return basis. Most first-time investors, they want a house. They want a house and land package because it feels safe, but it's typically got the lowest return and it's not cash flow positive. And I say that with a national hat, including places like Christchurch where houses are really cheap. So house and land packages, though, a finished house is a safe place to invest in from a risk perspective because you can sell it to an owner-occupier. Now, in the world of different locations, this matrix can be, the apartment could be more attractive, take Christchurch, for example, than a house and land package because price point wise, it's still early at its product cycle stage. But in general, right across the board in New Zealand, houses typically cost more than townhouses, which typically cost more than apartments. But as you go into those different product categories, the risk changes. So house and land packages are typically the most lowest risk, but it's also the lowest return product. Townhouses, a little bit more risk because it's not the New Zealand norm yet, but it's changing, the demographic that is changing as a psyche. And then apartments. You know, there's far more townhouses and houses in Christchurch than apartments, whereas if you look at central Auckland, there's far more apartments than houses. So this can change on the spectrum based on where the location is. But in terms of in general, there are more houses in New Zealand than townhouses, and there are more townhouses than apartments. And as a product type, the townhouse is dropping down the risk path. And right now, we're seeing townhouses as probably the highest returning product and the lowest risk. So we see that as such a safe place to be, which is why it's our number one product type. Property trading, you know, that's a much, much higher risk and return product, as is wearers, which is a type of product in Christchurch. Bare land. If you're a first, second, or third time investor, you shouldn't be anywhere near those products. And if you're a high-rise developer watching this, it means that you need stock sold, so give me a call. So we try and use this matrix to explain to people where does the product sit. And for first-time investors, we want them in the lowest risk, highest return product. And right now, that's your townhouses, subject to location. Christchurch apartments are still cheap. But, you know, it's hard to make apartments work in Wellington and Auckland right now unless you're out into the burbs. So, yeah, again, if in South Auckland, there are some very, very attractive apartment deals that do make sense. And we are scouting that location at the moment for some good ones where the numbers are sensible. So what I'm going to do soon is take you now for a quick tour of our website, because one of the things that we use to help people go from Property Investor 101 to 202 to 303 is the way that we present our deals on our website. So I'm going to take you for a quick tour of our website, focusing on our Auckland projects, and I'm going to start educating and articulating to you the things you should look for when you're looking for a deal. And hopefully that's through us, and if it's not through us, great. We just want people to get onto the property ladder. But we've built our website to be very educational, informative, and to be financially literate, to put product into terms that make you financially literate as a property investor. So I am going to jump into this now. But before I do, just want you to all understand that we're an extremely compliant business, or our compliance is important to us. So we're members of Real Estate Institute of New Zealand. We use different software programs where we are authorized, we're registered under the Real Estate Authority, and we have different CRMs that manage our real estate transactional business, and including the anti-money laundering. And I guess we manage that. The reason I'm showing you this is that when you transact with us, if you deal with us, everything that we do is extremely compliant when it comes to the law and when it comes to managing a transaction, because we're conscious that we're dealing with $300,000, $400,000, $500,000, $600,000 items. So we will basically hold your hand through the purchase process to the point that you can do everything with us as digitally as possible in New Zealand. So everything that I'm about to show you now, they are properties that are on the market through our business, and we are a facilitation business that helps you understand, well, why is this property better for me than this other property? I'm going to take you for a quick tour of our website now, and assuming the technology works for me, which it looks like it is. So this is our website. You can jump on at any time. But the one thing you can't see are the deals that we've got on our website until you're a member. And when I say member, it costs nothing to be a member. And if you click on the Join Now button, you can fill out a form and become a member. So I've logged in here as a member, and I can see our current projects. I can see our investment capacity report, which I'll talk about in a minute. So these are our latest listings. There's 4 new listings that have been put up there. One's in Te Atatū Peninsula, one's in Christchurch Central, one's in Hamilton, one's in Wellington. So these are just our showcase listings. This is our site. So I can fly around the country and look at different projects in the different locations that we've got. And we have a number of different past deals that we can show you. We've got past opportunities. So these are recent projects, but I don't want to look at old projects. I want to show you new projects. So I'm going to go to the current projects tab. And what that's going to do is take me into our website. Actually, I'm not going to, oh yes I will. So we've basically got a number of different projects around the country, and I haven't got time to take you through all of them, so I'm just going to focus on a couple in Auckland. The first one I'm going to pick is just this one in Te Atatū Peninsula, which is on Karamu Street. So this is how we present every deal. All right. So I'm going to turn my video off so you haven't got that on your page. Stop video. There we go. So this is how you see our deals, and everyone is laid out similar. First, there's a quick overview of the deal. I'll just zoom in so you can see that. Of what it is. This is 10 bedroom townhouses. These are cash flow positive, 54 to 76 bucks a week. That's a week. So that's $2,500 to $4,000 in Auckland, pre-tax positive. That means rent, if it's 20 grand a year, less expenses. If that's 15, you've got $5,000 left over. So this is 54 to 76 bucks pre-tax positive per week. That's before, that's including a tax benefit. So that is positive cash flow property, okay? So it's not having to be topped up with personal income. Rent covers all costs, and you've got a surplus every year. So prices in this project are 640 to 655,000. They're all 2 bedrooms. We see this product at 6 o'clock on the cycle. There's a quick 2-minute intro of the deal from me. So this is a real opportunity that people can buy. We've then shown, we give you the stats for Te Atatū Peninsula for the last 20 years. And you can see that the median sale price is 871,000. Currently 200 townhouses per annum are selling there, which is pretty low. I can also see here that it's taking 39 days on average for townhouses to sell, which is pretty quick. And so we've got a lot of stats we put on here. We then look at the cost of ownership. If you're a first-time buyer, this is going to cost you $695 a week to own. If you're a first-time investor, it's going to cost you $340 a week to own. And a first-time investor is a first home investor is a first-time buyer who rents out one of the bedrooms. And we encourage that all the time. And then there's property investors with forecast rent for these properties from $570 a week to $700. These are 15 minutes from Auckland CBD. That rent is real. It's come from multiple property managers. And this is a brand new property. It's not secondhand, leaking with single glazed glass. It's brand new. It's double glazed, latest building standards. So as you can see now, we've got the availability of properties on our website. So you can scroll through and see what's available. There's only 4 left now. There are 5 that have gone under contract very quickly since this was launched literally in the last couple of weeks. If you want to actually secure a property, and this isn't, you're not buying one, you're putting your foot on one, you can literally fill out a form on our website that will take you through what's called a request for contract. You are requesting that somebody sends, or one of our team sends you a contract. So this is the legal information we need to know. We can refer you to a broker or a lawyer if you need one. So this is all of the information we need from you. It doesn't cost you anything, and you can fill that out from here. If you want to ask one of our team about this property, you can click on this link here, and it will take you to our list of fabulous people around the country that will help you understand a bit more about the deal. So it's got all of our contact details. You can email me or call our people, that's all on our website. But let's go back to the deal, because I want to take you more through the numbers again, and it's just refreshing. So when we analyze these deals, we do it with what does it look like today? How does it look over 10 years' time? So we do that with a lot of information that you can download. So the first one of those is a forecast. Okay, so if I'm going to pick the property investor forecast, not the of an unfurnished property, which is your long-term low risk. This is how this property is going to perform. So after year one, this property, as I said, we've got rent less costs. This is at $615 a week. Less costs is paying you $54 per week before tax. So that, from a property investing world, is rare in Auckland. $3,000 pre-tax per annum, $54 a week. So we're showing you this property in after year 1, 3, 5, 7, and 10. So I'm not going to spend time on this cash flow. We're going to start doing workshops on these cash flows so that you can understand them, because we've got a principal and interest calculator versus interest only. But just to summarize how this property is going to look in 10 years if we use historical growth rates. If you're paying a principal and interest loan, that means you're paying debt off as well as interest only, versus an interest only loan where you're just paying interest. So the property will perform the same. This is forecast to go to 1.5 million over 10 years. If it's an interest only mortgage, you will have created equity in that property of $873,000. If you were paying a principal interest loan, you would have created equity of over $1 million, because you've been paying off the debt as well as getting capital growth over time. So we will educate you on these cash flows through our team or through some forthcoming webinars that we've got coming up. Every single deal has a cash flow like this. If you don't like our numbers, and these are our assumptions on the left, cool, we'll send you our cash flow model so that you can do your own numbers and your own metrics. So let's just jump out of that. Every single deal has these cash flows for them. This property, as I said, is in Te Atatu Peninsula. There's renders on our website. There are images of what it will look like finished. This is an off-the-plan deal. You can see where it is in the area on Google Maps, and you can see it on where it is in relation to the CBD and other major infrastructure. So this is where the property is now, and a bit of an overview, Auckland overview. So every single one of our deals is promoted the same. And I'll just jump into a Christchurch deal that's finished. It's complete, just to show you that we use the same metrics. So this is a finished product, but it's still classified as new because it is brand new. There's some lovely videos of me talking about it. We see this product at 7 o'clock. This is a complex of 1 and 2 bedroom properties from 300,000 to 470,000. It's, for what they are in our eyes, just ludicrously cheap. We give you the same historical information on the suburb, the cash flows, availability, and cash and assumptions. You can now, on this one, these are actually real photos. These are actual photos. So this is a complex that's built, so you're going to get rent from this from day one. It's been built by the largest builder in the country, being Fletcher's, and it's one of the most impressive properties we've seen since we started our business in terms of quality and bang for buck. Specifications for it are unbelievably high, and it's 1.5 kilometres from the CBD of Christchurch. That was a Google Maps photo once, a street view photo when it was being built, which is now complete. So we have a lot of information on this project because it's finished as opposed to being off the plan. However, every one of our projects, we get as much due diligence as possible. So that's a Christchurch property. And I'll jump now to a Wellington one, which we literally launched in the last 2 days, once I can find it on our website. Here it is. So again, infill housing, a developer has bought a bunch of houses. They're going to bowl them and create, in this one, 8 one-bedroom townhouses. It's in Waiwetu, which is in Lower Hutt. These are one-bedroom townhouses priced between $510 and $525. Now, we have struggled to get product in Wellington, and we put Wellington on the property clock at 10 to 11 o'clock. We put this product in this location at 7 o'clock. This is so early in its life cycle. Very few people have seen this kind of product in a location like this. So there's a video of me giving you a bit of a download on it. There's suburb performance. So this is the kicker for me. The average sale price for townhouses and houses in Waiwetu is $679,000, and these are $500,000. So when you're buying that far under the median, it's in our opinion pretty low risk. So from a location perspective, it's safe, it's under the median, and price point wise, and we've literally just launched this, so we've got 8 properties available. 8 properties available, and they're all between $510,000 and $525,000. When people ask me which one's the best, I always say the cheapest because it's going to give you the highest yield. So these are $57 a week pre-tax positive, which is nearly $3,000 per annum. Now, in Wellington, that's just unheard of. They're not. It's not first home buyer product. First home investor product because there's only one bedroom. But this developer is about to launch more of these in the 2-bedroom space. But again, great location. You're 10 minutes from Petone. You're 10 minutes to Lower Hutt. You're 15 minutes to Wellington CBD. In a location which has solid history. So this is how we present deals on our website. Every location that we put, we've got Hamilton. And this is a finished product in Hamilton. I may as well cover the 4 cities since I've done this. This is a completed project of 3-bedroom townhouses. We see this location at CBD Hamilton at 8 o'clock on the market. And again, these are positive cash flow. They're finished. There are people that live in them. These are over $5,000 a year positive cash flow for a 3-bedroom townhouse. Price-wise, from a Wellington, Auckland perspective, in my opinion, are just super cheap. There's only 5 available. 5 available at $665,000 each for a 3-bedroom, 2-bathroom, 2-car property in the CBD of Hamilton. So, this is how we promote and present our investment properties. And whether they're off the plan or finished, like these last 2 ones, that's 2 off the plan I showed you and 2 finished ones. We do the same level of homework, and I believe we do about 80% of the due diligence on a deal, and that you need to know when you're investing as a property investor. So I think that's what our point of difference is. We give you a lot of the due diligence on a deal, and it gives you the information to make a considered decision. So I'm back to my little PowerPoint presentation. So one of the things you can do, which I think is unique to our business, is you can fill out a form online, which I will go back to my website. I'll show you what it is. On our website, we've got this wonderful product called an investment capacity report. And it comes from my broking background. But if you click on this investment capacity report button on our website, once you're a member, it'll take you 10 minutes to fill out the information. And we will send you a 6-page report that explains to you your financial situation. And we've done it in a language which is very clear, and it makes sense for you. And we will then talk to you about it to make sure that you do understand it. So this is a pretty unique product that we've developed for our customers. And at the end of it, you'll get this report. This is one of the pages out of it, which basically shows you your world in the eyes of a bank. And I won't take you through this one now because I'm already over time, but this is an example of a client who has got high income, moderate equity, and the goal for all property investors is to have a balanced equity and income, because that will enable your property portfolio to grow organically. Whereas this client can actually fund far more property than their equity will allow. And that's actually harder to fix than somebody that's got lots of equity but low cash flow. So, the strategy for this customer is quite narrow. Whereas if this client had $4 million worth of equity and $100,000 worth of income, that's easy to fix. So it's all about balancing cash flow with capital growth. And this guy's cash flow is high, capital growth or equity available to buy to get into property is lower. But they've still got strength. They can buy $800,000 worth of property, but they can actually service $4 million. So everyone's different and everyone's financial circumstances are different. And we have created these reports to basically mirror standard banking ratios and metrics. And what that means is your report will be created to match how the bank treat you when you go and get finance. Because it's completely hopeless if you buy a property that doesn't meet banking criteria and they give you a loan and you run out of what's called borrowing power. So this is a tool that our investment consultants will use with you to help you understand your financial circumstance. So we call it a financial literacy tool, and it helps you become more financially literate. So that is our business and how we can help you. If you haven't heard of us before, we can help you with an investment capacity report. Those are free. And a second report called a property matching report, which is even sexier than the first one because it shows how hypothetical properties that you could buy based on bank math, how they're going to perform over time. So that's a bit deeper. That report's about 10 pages. These are free. Please spend time on our website, understanding our deals, understanding the due diligence on our deals. And please, 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 if you've got a question, call one of our team because there's no such thing as a stupid question. We've been doing this for a long time. It's our bread and butter. And we respect that if you're a doctor or a dentist or a worker in any business, this stuff might be new to you. So we respect that. We're big on brokers and we're going to be sending out more information on good debt management. If you're with a bank direct, we'll recommend a broker for you because they know how to get and package your financial circumstances far better than your bank manager can. Pre-approvals, because of COVID-19, are taking longer, but the brokers are saying still send us deals because, still send us customers because the time that we're saving now is money in the future so that you're in a position to buy. Getting a pre-approval costs nothing, so you should do it. Getting an investment capacity report costs nothing, so you should do it. So please use our services and would love to help you buy your first or next investment. I'm going to take some questions now. I think David's been beavering away in the background answering questions. So I'm going to have a quick look at those. I'm going to mute myself. But in the Q&A box, you can ask questions, and in the chat box, you can do the same. But I can see that David's been furiously typing, so he's made my job easy. From that point of view, thank you, David. And I'll just mute myself so I've got a bit of time to have a bit of a read and see what kind of questions we've been getting. Oh, actually, I can see that David's been answering all of them. So what do we got here? I think I've muted myself. No, I haven't. Right. Because I like to read some of them out because it's, if you can't see them, which I'm assuming you guys can't. Someone said, we mentioned infill housing is at 6/7 o'clock. However, KiwiSaver, KiwiBuild are currently capped at 650K. And it's unlikely that this cap will double over the next decade, and this will limit capital growth. So no, I'll clarify the KiwiBuild, KiwiSaver. KiwiSaver is basically, you can access that in retirement or you can access that to buy your first home. You've got one crack at it. So if you're under 650 in Auckland, you can buy a property that's 550 in Christchurch, I think, or maybe gone to 600, but let's say it's 550. You can access your KiwiSaver. So that's deposit money you can use. In terms of Kiwi Build criteria, Kiwi Build from a government point of view has been a shambles, an absolute shambles. But right now in New Zealand, as a first home buyer, you can borrow 95%, you can get your Kiwi Saver out, and what the goal is getting on the ladder. So your capital growth is not going to be limited by Kiwi Saver or Kiwi Build. Your capital growth is going to be limited by the market. So once you're in, you're on the property ladder. And my advice to first home buyers is to buy in a location that's at 6 or 7 o'clock, use your Kiwi Saver, get your first home buyer grant, get a 95% loan, because you are the bank's number one client that they want. So, yeah, I don't know how Kiwi Build or Kiwi Saver is going to limit capital growth, because you don't need to spend $650,000 to get on the property ladder, as we've just shown. You can spend far less than that, even in Auckland. Infill housing has an ample supply due to the unitary plan. So new infill supply will always meet demand and keep capital growth low. I actually disagree with that, because the land that these developers are buying are in locations where the average house price is extremely high. Secondly, infill housing is expensive. You've got to put all the services in, and in some locations in Auckland, the developers got ahead of the government or the council in putting, not being able to actually put, the services weren't there before the houses were, or the houses, and it put pressure on the system. So the unitary plan from a long-term capital growth perspective is levelling Auckland off. It's already doing it. But the capital growth that we're going to get in New Zealand isn't the Auckland unitary plan, it's housing. It's demand. We're 50,000 houses short across the country, and you can apply 50% of those into Auckland. So until we actually have supply meeting demand, capital growth is real, and it's in some of those locations, it's far greater than the long-term average. Full section housing still has potential to be redeveloped, and also has a bigger floor size, so it justifies a higher price tag. Technically, yes, but development is expensive. And if you've got a house with a big section and you want to put another house at the back, do the math. It won't be economical. I've got business colleagues who do this as a job, and it's very, very hard to get a good margin out of it as a developer in Auckland. So it's not just a case of buying a house with a big section and thinking you're going to be a developer, because development in this country is so expensive that you need to know what you're doing. So yeah, the Auckland unitary plan, infill housing and greenfield subdivision is really what saved the Auckland market from having a drop off, because prices in Auckland in the CBD and established areas have gotten to the point that only a small percentage of the population can afford it. But those two properties I showed you today in Auckland are affordable for first home buyers on moderate incomes. So I see infill housing as the solution to the Auckland housing infrastructure problem. And it probably came 5-10 years too late, but I still see it as very important. Other questions? No, I think David's got them all. Well, I'm going to be here for a few more minutes to answer any further questions. And if you have any questions, please type them in. Otherwise, talk to one of our team. Do an investment capacity report request. We'll send that out within 24 hours. And in the meantime, stay safe in this very confusing and bizarre time of COVID-19. And but get ready to invest, because our market is not changing anytime soon, in my opinion. Thanks, and have a great day.